From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, the latest inflation stays in line with expectations, but still well above the Federal Reserve's 2% target, only furthering division on the next steps for the Fed's rate path. And credit issuance in Europe and the U.S. shatters records for September as demand for yield persists. We begin with the big issue, the Fed's path forward.
The economy will be in pretty good shape for the rest of this year and into 2026.
The year-on-year rate of core inflation is getting ever so closer to that 3% level.
The Fed is cutting on risk management grounds into what may be the early stages of a cyclical reacceleration.
The Fed should not be in restrictive policy.
The Fed has to be mindful about not slow walking into an accommodative monetary stance.
The Fed's in a difficult position.
We're in a critical juncture.
There's some resilience in the bond market.
The flattening that we've seen is a bit of a buy the rumor, sell the news on the back of the Fed.
The yield curve is kind of in equilibrium here.
The spreads are tight, but yields are right.
We're seeing a lot more interest in bonds.
The bond market's not as expensive as everything else.
Longer-term steepening view is still our core view.
The bond market is pricing in the Fed effectively gets to 3% by this time next year.
You can't rule out that they skip December.
There's a lot of easing also priced in for 2026.
Also, a relatively inline batch of economic data this morning. You had personal income and personal spending rising more than expected, while inflation in August, as measured by PCE, which is the Fed's favored gauge of inflation, coming in bang in line with what economists had anticipated, up 0.3% versus the previous month. And if you strip out food and energy, up 0.2%. Now, when you look at sentiment was a little bit weaker than what economists had anticipated, and consumers are a little bit feeling better about inflation than what economists had anticipated as well, but still looking at a 4.7% gain over the next 5 to 10 years. And that has contributed to fading momentum for disinflation overall. You can see the ramp up in consumer and wholesale prices throughout 2021 and certainly in 2022. The turning point was the third quarter of 2022 after the Fed began hiking rates aggressively. But disinflation began stalling in 2024, and we are kind of stuck in a bit of a range right now. Now, after a packed week of Fed speak, it is clear that central bank officials have not quite reached a consensus.
Policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area.
It's important that we stay restrictive to bring inflation back down to target.
We're close within range of what our mandate is, close to 2%, and we should be shifting our focus to preemptively and proactively support labor market conditions.
Both of them have ticked in the wrong direction, but on the other hand, the downside is limited, and we're just going to have to, adjust our stance as we learn more.
A challenging situation. Two-sided risks mean that there is no risk-free path.
Joining us now is Mike Contopolos. He is Deputy CIO at Richard Bernstein Advisors. Also with us, Leslie Falconio. She is Head of Taxable Fixed Income Strategy at UBS Global Wealth Management. Welcome to both of you to Real Yield. Leslie, let me start with you. If you could reflect on this week's data, which we just kind of recapped, but against this backdrop of a stronger than expected economic performance in the second quarter, is the market right to price in rate cuts in October and December and a string of cuts in 2026?
Well, I mean, we think that the Fed's going to cut it twice in 2025. I'm not so sure about the string of cuts in 2026. But I want to say that the data that we've had the past couple of days, should give pause to anyone who really believes that we're going to go into recession, which we don't. I mean, the second quarter GDP revisions were strong. The durable goods CapEx had gone up. The jobless claims was on the stronger side in terms of having the labor market cooling but not collapsing. So we do think the Fed does cut, in the next two meetings. But you're cutting from a level that's still relatively high. What we didn't agree with, more importantly, was how quickly the market was pricing in that 3%, which was at one point in time around that Fed meeting, almost happening, in that, May, sort of June area, they were already going to be at 3. So it wasn't just the amount, but how quickly they were going to cut. We only think they're going to cut probably once in the first half of 2026. But again, the data will dictate.
Got it. Now, of course, today's PCE data really is further proof that inflation is above that 2% target. And Mike, I know you've been consistent in your view that transitory inflation is a bit of a myth and that inflation will persist. So tell us how you see it playing out. Is inflation simply stabilizing at a higher level rather than 2%, or is there going to be a meaningful pickup in the fourth quarter next year as the tariff impact gets absorbed?
Well, I think, if you look at that chart there, first of all, really since April, the chart you're showing earlier on inflation measures, really since April, since tariffs, we've seen inflation start to trend higher. And if you look at Supercore PCE, it was also trending higher this last month, and of course, that's one of the key inflation measures that Chair Powell absolutely loves. I think we've probably seen, Jamie Dimon said this week, we've probably seen 40 or 50% of the pass-through of tariffs to inflation. The rest are being taken on by companies with respect to their margins. There's clearly inflationary pressures that are going to keep the Fed questioning their decision whether or not they should cut rates over, I think, October and December. I could easily see September being a one and done. Would not surprise me one bit at all. Mm-hmm. I just don't think it's really that clear that inflation has been slayed. And to Leslie's point, I do think it's pretty clear that we're not headed towards recession. In fact, if you looked at 30 versions of the Taylor rule, which are shown on the Atlanta Fed website, out of 30 versions of the Taylor rule, 0 would suggest that they should be cutting. There is they are not restrictive at the moment. Credit's at all-time tights, and people forget the way monetary policy works. It works through the transmission mechanism of the banks and lending. And if you can find me tight lending conditions out there, I'd be very, very surprised to know where it is.
Well, to that end, Dallas Fed President Lori Logan has floated the idea of the central bank replacing the Fed funds rate as its benchmark. She says the time has come for the FOMC to prepare a target for a different short-term rate. One might say, since all is fine for now, there's no need to act. But if transmission between Fed funds and other money markets ever broke down, we need to quickly find a replacement target. And she thinks it's better to do something when there isn't the time pressure to forcing everyone to move. Leslie, do you agree that changing to a more widely used rate would be an improvement, would perhaps make monetary policy more effective?
I do. I mean, a lot of people refer to like the Fed fund rate as the LIBOR situation where you just have a lot of volume, it's a little bit static. But the problem is with this, this kind of movement in terms of changing, it just takes a long period of time. But this has been, spoken about before. I think it's a smart thing to do, but I just don't expect it happening anytime in the near future.
How disruptive would that be if they do something, Mike?
I don't think it would be, you saw the chart you just brought up, Scarlett, and you can see how closely it tracks the federal funds rate. I don't know how disruptive it would be. I actually kind of agree with Leslie on this front and makes a lot of sense over time. But, again, it's sort of a priority issue and when the time is right type issue. I don't see any pressing need for it today, and I don't think it would be a huge deal if they do so, but... so I don't think it would be a massive volatility event at all.
Okay, well, something that's happening closer to what's the current moment is it looks like long bonds are somewhat back in favor. We've seen how since early September, U.S., Japan, UK 30-year yields have fallen between 15 to 25 basis points. And it seems like, Mike, all it took was a reduction in long end supply that prompted a rethink. What's your read on this?
Yeah, actually, I think it's quite healthy. I was pleasantly surprised. You saw the 30-year and the long end of the Treasury curve rally after you got the poor jobs print, earlier this month. And I thought that was pretty suggestive to this idea that, there's still efficacy to the safety of the long end of the Treasury curve. That when, folks get scared, volatility picks up, there's fears of a recession or an economic slowdown, that the long end's going to provide nice returns for investors. And as supply has slowed and as there's been more uncertainty around the economic data, the inflation outlook, et cetera, the long end has reacted accordingly. And I think it's actually a really positive and healthy sign for 20 and 30-year paper that, deficit issues, fears around, fiscal largesse, et cetera, is maybe tomorrow's story and not today's story.
Got it. Well, what could be a today's story, or at least in the next week, is the idea that there might be some kind of government shutdown. Leslie, very quickly here, what is the risk that the market won't get the September jobs report next Friday because of some kind of disruption, some shutdown?
Well, I mean, it's a high. I mean, they're putting a high probability to the shutdown. What to your point, you just don't know how long it lasts. So it's definitely out there. People might have to look for ADP again. We don't view as a shutdown as an impact on the economy. We've been through this so many times, but it does depend on the length in terms of how it impacts the market. But you can't put a zero probability to that, to the fact that they won't have the data.
Good stuff. Mike Contopolos of Richard Bernstein Advisors and Leslie Falconio of UBS Global Wealth Management. Thank you both so much. Coming up next on Bloomberg Real Yield, the auction block. September issuance records are being set in Europe and here in the U.S., where high-grade sales are on track to top $200 billion. That milestone only achieved 4 times in history. Credit is next on Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, U.S. investment grade and high yield, both setting records for issuance in September. We start with high grade. The big headliner was Oracle, with its $18 billion sale, pushing this month's volume closer to the $200 billion threshold. September is now this year's busiest month for sales. Digging into Oracle a bit more here, it is the market's second largest deal this year as the legacy software maker turned AI darling ramps up its spending to meet the needs of the AI boom. Demand peaked for at the almost $88 billion for the debt offered in 6 parts, including a rare 40-year bond. And in junk bonds, September's volume set a record for the month at more than $48 billion. This week's issuance of more than $17 billion was the busiest week in 5 years. Now, sticking with credit, Rebecca Venter of Vanguard says that active management is even more valuable with the current tight spreads.
Pretty tight relative to history, but I think this is where active can be really powerful because what our team is able to do is look under the surface. Even if the index is trading pretty tight, there's going to be differences amongst different issuers, and they can really find the ones that they like, the ones that maybe are at more risk when we think about things like tariffs, the slowdown in the labor market. And so I think that's actually what our team is focused on now, is really just continuing to drive value from individual security selection primarily.
Let's bring in our roundtable on the credit market. Joining us is Lotfi Laroui. He is Chief Credit Strategist at Goldman Sachs, and Sonali Pier, Portfolio Manager of Multi-Sector Credit over at Pimco. Rebecca talked about spreads being tight, and there's, of course, a lot of money chasing still not enough supply, even after this month. And you see that in the response to Oracle's offering. We know that investors want yield and duration, but Sonali, let me start with you. What is the argument for owning debt from a company in the super fast-moving AI part of the tech world? Does a 40-year tranche make sense as a concept?
So, we are seeing a lot of demand for credit overall, and certainly high-quality fixed income is resonating. And with that, with the trends towards AI, if you can identify those credits that are likely to benefit from this trend, extending out the curve can be something that's attractive. Generally, we've found the credit curve to be pretty flat and have preferred 10-year and in issuance on a relative basis.
But I guess the question here is that, investors do want to lock up yield, of course, for as long as possible, Lotfi, but Oracle is not the U.S. government. Oracle is not even a utility where people can be comforted by the fact that it'll still be there in 40 years. This is a tech company in an industry that moves incredibly fast. Will we still have the same Oracle in 5 years or in 40 years?
That's always an open question when it comes to tech deals. But I would say, look, investors in general are willing to reward growth stories, and I think credit is no exception to that. So what you've seen through that, record high participation is just a testament to that. September, to your point, is typically a pretty busy month from a seasonal standpoint. This month was even busier than usual. Some of it also reflects a lagged response, or a natural response, I should say, by a lot of issuers to the big decline in yields that we've seen in the prior couple of months. Composition has been friendly, so I would say all good from a supply-demand standpoint, even though the numbers are big, as you were alluding to.
Yeah, we were just showing the credit default swaps and Oracle's debt jumping to the highest since May. So not everyone's convinced that all this borrowing will be risk-free. Sonali, is this something, the Oracle 40-year bond, that you would buy and hold to maturity, or is that something that is really designed to be flipped?
Yeah, so we are active managers, and so from our perspective, we're always looking at changing dynamics in a credit, whether that's the fundamentals, whether it's the sector industry trends, or just overall the themes in the market. And so when we're investing, we are looking ahead and looking to commit our capital on behalf of investors for quite some time. But that's the beauty of public markets. If trends are changing and if we're seeing weak signs of weakness, we can certainly rotate the portfolio and be active in our selection, making sure we're really taking advantage of the best relative value.
Junk bond issuance was the busiest since 2020, but about over one third of this week's U.S. junk bond tranches have seen pricing widen slightly from face value versus the broad initial gains that new high yield notes have been logging as of late. Lotfi, performance has cooled. Yields are set to rise for the first time in 8 weeks. How do you see this? Is this a pause in the rally, or is this perhaps an actual turn?
It's not the easiest setup, to be perfectly honest. I think if you're a spread investor, clearly you're facing some pretty binding valuation constraints. I think spread, at least at the index level, are multi-decades high. At the same time, growth is weakening, the labor market is sort of flashing yellow, and the Fed is most likely prepared to continue to ease. And so really the challenge, in my view at least, is to find expressions that do give you a little bit of upside if monetary policy continues to ease, while also protecting you, to your point, against the risk of a widening here. There's all sorts of trades that you can think about that are structured that way. But what we have been arguing is that you should look for sources of excess carry. I'll give you one example: mortgages versus investment grade. There's a pretty sizable carry pickup on the mortgage side that we actually like. And then seek to use a portion of that to fund some hedges in credit portfolios. But really, you sort of have to be long policy while keeping an eye on growth risk, and that's not an easy equation to solve.
Yeah, well, you mentioned risks, and I think about what we've seen in the last couple of weeks, Sonali. We've seen some massive companies blow up, Tricolor, for instance, as well as First Brands. No one really saw this coming, and we saw the price of their debt tumbling. How much does that give you pause?
Yeah, this is the credit market. We're always going to have these idiosyncratic stories where we need to be ready to react and or ideally predict. And so, again, this is part of that active selection. We're looking for opportunities across asset allocation, regional selection, industry selection, and security selection. And even when we talk about that, so, again, we can look at securitized over corporate, but even honing in on, some of these more storied names, as you go lower in credit quality, that's where you tend to have more spread dispersion and where investors need to differentiate between credit quality, those that will actually improve and those that actually may even default. This is back to that why, even when spreads are tight, credit selection is still really important because you still have moments like those.
Sure.
From our perspective, we look to buy, yes, strong credits, but think about the scenario analysis across a wide variety of sensitivities.
Lotfi, what does that say, though, about other potential problems lurking out there as spreads continue to grind tighter, that you can have these blow-ups that come seemingly from out of nowhere and surprise everyone?
Look, I do agree with Sonali. I think, idiosyncratic risk is that's the way things should work in a normal credit cycle. But the bigger question, I think, with respect to this particular example is whether that is indicative of broader weakness in the consumer space. I don't think so. I think, most of the rise in delinquencies in the auto loan market in particular has been concentrated among subprime borrowers. Prime borrowers have been fine. And so to me, the takeaway is that the low end of the income distribution among consumers is certainly vulnerable to any exogenous shock, particularly if it's a negative growth shock. But I don't think it's indicative of broader weakness in consumer. And I think if growth rebounds in 2026, if anything, this signal is probably backward looking at this point.
How might investors hedge against more unexpected blowups, Sonali?
And, again, these can be difficult to predict, but most importantly, it's if you do the credit due diligence up the front, the research, you can build a portfolio in times like this that can keep up on the upside, but have that downside protection, right? So looking at at this point rotating from some of the cyclicals into non-cyclicals. It's not quite the spread give that it would have been, before, or looking at some financials over non-financials in the case of investment grade. As we look into high yield, again, there's a good portion, 30% of that market is secured, but it's important to realize security doesn't necessarily, it depends on the covenants, it depends on the structure. And so again, getting under the hood, getting deep into the credit analysis is the best way to protect the portfolio.
I want to thank our roundtable, Lotfi Laroui of Goldman Sachs and Sonali Pier of Pimco. Thank you both so much. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Still ahead on Bloomberg Real Yield, the final spread the week ahead. We're going to count you down to the next U.S. payrolls report on Friday. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is now time for the final spread, the week ahead, and what we have coming up include, starting on Monday, President Trump and Israel's Benjamin Netanyahu meet at the White House. We're also going to get Fed speak from John Williams, Alberto Muslim, and Raphael Bostic. Also, earnings from Jefferies and Carnival. Let's move ahead to Tuesday. The U.S. government could potentially shut down at 11:59 p.m. That's if Congress doesn't reach an 11th hour deal. On Wednesday, EU leaders will be meeting to discuss defense and Ukraine. Plus, we get U.S. auto sales as that EV credit expires. There's been a rush towards buying EVs before that expiration. And that leads us to Thursday. Tesla will release production and deliveries data. We already got a sense of production and deliveries in Europe not being so great for that company. We're also going to get fresh U.S. data on jobs. The Challenger jobs cuts report will be coming out then. And then on Friday, the big U.S. jobs report for the month of September comes out at 8:30 a.m. Over in Europe, the central bank president, Christine Lagarde, will be speaking, and outside the world of finance, Taylor Swift will be releasing her latest album. Now, for my final thought, let's take a closer look at that jobs report due on Friday. If the government does report it in time, because we are potentially looking at a government shutdown, the consensus right now is for the economy to add 50,000 jobs. That is a jump up from what we saw last month, 22,000. And the unemployment rate is expected to stay stable, unchanged at 4.3%. When it comes to earnings, average hourly earnings will increase by 0.3% from a month ago. On a year-over-year basis, we're looking at an increase of 3.6%, according to the Economist surveyed by Bloomberg News. From New York, that does it from us here at Bloomberg Real Yield. Same time, same place next week. Keep it right here. Bloomberg Markets is up ahead.